Hey everyone, welcome back to Corporate Decoder. Today, C.H.4 Natural Solutions Corporation just filed an 8K announcing unit separation, and I am seeing one subtle detail that matters. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing is all about how investors can separately trade parts of their investment, and it points to a company getting ready for more action. So what is happening here at C.H.4 Natural Solutions Corporation, ticker symbol MTNEU, on the New York Stock Exchange? This is a current report, basically a heads up to investors about something important that just happened. The big news is that starting the 22nd of June 2026, the company's units, which are made up of shares and warrants, can be traded separately. Think of it like buying a bundle deal at a store, and now you can choose to buy just the shirt or just the pants. For investors, the units, which trade under the symbol MTNE, are now splitting into individual Class A ordinary shares, which will trade as MTNE, and warrants that allow you to buy shares at a certain price, which will trade as MTE double. These units are essentially a package deal. For every unit you own, you get one Class A ordinary share and half of a warrant. The Class A ordinary shares are the basic ownership stakes in the company. The warrants are like coupons that give you the right to buy more shares later at a set price, in this case $11.5 per share. This separation is a pretty common step for companies, especially those that have recently gone public or are looking to increase trading liquidity. It allows different types of investors to buy exactly what they're interested in. Now, C.H.4 Natural Solutions Corporation is identifying itself as an emerging growth company. This is a designation that allows companies to use certain provisions under US securities law to ease their reporting burdens for a period of time. It means they might have less stringent disclosure requirements compared to larger, more established companies. This designation is often used by companies that are still in their early stages of growth and are working to build their business. Let's talk about these warrants. The fact that they are exercisable for one Class A ordinary share at an exercise price of $11.5 is key. If the company's stock price goes above $11.5, these warrants become more valuable because investors can buy shares for less than the market price. This also signals the company's confidence that their stock price will exceed this level, making the warrants attractive. The press release attached to this filing, Exhibit 99.1, is where the real narrative starts. It confirms that holders of the company's units can now choose to trade the Class A ordinary shares and warrants separately. Importantly, they mention that no fractional warrants will be issued upon separation, meaning only whole warrants will be available for trading. This prevents awkward situations where an investor might own a fraction of a warrant that can't be easily traded. The intention behind this move is typically to increase trading volume and provide investors with more flexibility. When units are traded together, it can limit the pool of buyers and sellers. By allowing separate trading, the company hopes to attract a broader range of investors interested specifically in either the equity component, the shares, or the potential upside from the warrants. While this specific filing doesn't contain detailed financial tables, this type of event often precedes significant corporate actions. Companies might do this to prepare for future fundraising, a merger, or even just to boost their stock's visibility. Given that C.H.4 Natural Solutions Corporation is in the natural gas sector, and there is news about methane mitigation SPACs, this move could be positioning them for something bigger in that space. For example, a company like Riverstone's Lucian might be looking at similar strategies to bring entities to market or enhance their trading characteristics. Looking at the bigger picture, this separation is a sign of a maturing company. They are evolving their capital structure to better serve the market. For investors, it means they need to be aware of the different components of their investment. Investing in the unit is one thing, but investing in just the shares or just the warrants is a different strategy with different risk and reward profiles. The risk here, as with any company, is that the market doesn't react as hoped. If trading volumes don't increase significantly, or if the stock price doesn't perform well, the separation might not achieve its intended goals. It is also important to remember the context of emerging growth companies. They often face higher volatility. What I am actually looking for is how this separation impacts the company's ability to raise capital in the future, and if it leads to increased investor interest in their core business, which seems to be related to natural solutions and methane mitigation. This is a positive step towards greater market efficiency for their securities. But the ultimate success will depend on the company's underlying performance and strategic execution. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you found this helpful, please like, subscribe, and join our Discord community linked below.